Hello traders, I'm James Stanley with StoneX and Forex.com. There's an old saying, don't fight the Fed. What about don't fight the Fed, the Treasury Department, and the White House? Because for 2026, it looks like we're going to be in the unique position of having all three entities firing in the same direction, all looking to pump equity markets as much as humanly possible ahead of midterm elections later in the year. Now, I've covered this in the past for StoneX TV, where I've looked at the prospect of an AI bubble. And as I said then, knowing that there's a bubble is all good and fine. Timing that bubble is far, far different. But I wanted to use this video to look at my expectations for 2026, and then I wanted to transfer that into what I think, or what I expect to be my top trade idea for 2026. And it's not quite in stocks. But let's get to the chart, start looking at this, and start diagramming how we can set up for next year. So first and foremost, on a shorter term basis, there already is a bullish breakout setup in stocks. This is cash SPX. There's an inverse head and shoulders pattern. Inverse head and shoulders pattern often approached with aim of bullish breakout. And with that pattern, it's all about resistance. It's all about the neckline. In this case, the exact high was set on October 29th, which I think is notable. And that's something I'll talk about in a moment. But from the formation itself, we could look at the way that this drawdown, this pullback had developed. We could look at what was behind it, and then we could start dissecting that to figure out what these drivers were. Now, that high on October 29th, that was the previous Fed rate decision. Now, at that point, Powell had his second cut of the cycle, but he demurred about a cut in December. He said it wasn't a foregone conclusion. Now, it started as a mild pullback, but along the way, we started to see or sense a greater sense of fear around an AI bubble popping. And, you know, it was as we got some of these large sell-off days, some of these gap and goes, that you started to see headlines accusing markets of being in one giant, massive AI-fueled bubble. And, again, we talked about that in these videos, where there are definitely tendencies of a bubble showing. I talked about this in the 2025 forecast at the beginning of the year, where there's a lot of similarities, particularly in runaway valuations, a lack of revenue generation from AI. Now, the revenue problem isn't as big in AI as it was in .coms, but there's a similar relationship in there. But in both cases, the innovation or the investment in innovation was largely driven by cheap capital. And it was when that capital became not so cheap in 1999 and 2000 that matters started to come apart. Now, the reason that I expect or am looking for a melt up scenario here is, well, there's a few motives behind it. First and foremost, after the rate decision this week, President Trump said, I don't know why GDP growth couldn't be 20 or 25%. It's a pretty big number. But more to the point, he's also said that the appointment, the next Fed chair that he's going to nominate, the litmus test is whether or not they're open to cutting rates. And it's been widely circulated that he's said he already knows who the next chair will be, but it's been widely circulated that next chair is going to be Kevin Hassett. Kevin Hassett, the current director of the National Economic Council, history as a noted Uber dove. As a matter of fact, this article from 1999 has Kevin Hassett addressing a very similar situation. At the time, markets knew or thought there was a massive bubble in tech that had already built. And this is Kevin Hassett in an article for AEI addressing Mr. Greenspan's comments. And he's excoriating Greenspan for threatening to check that bubble by raising interest rates to prick it before it gets too big. Well, this was 6 months before it burst. But notably, that was a full 3 years after Greenspan had initially made the claim of irrational exuberance. So Greenspan saw that bubble building well ahead of time, but the timing was off, of course. But this shows Kevin Hassett has a history of being really dovish, even when there is a massive bubble that's already been built. Now, that, again, was 6 months before the dot-com bubble had topped. But like I alluded to earlier, there's a reason that these things will ultimately turn over. Now, if you look at Fed policy, in 1998, the Fed cut rates three times, September, October, November. But then in 1999, this is right around the time when Kevin Hazard wrote that article. Again, that was from September of 99. In June, the Fed hiked 25. Then they hiked 25 in August, 25 again in November. In the year 2000, the Fed hiked 25 in February, 25 in March. March of 2000 is when stocks topped. And we didn't know that at the time. The Fed went for another 50 bips in May. And that ultimately is what flipped the whole thing over. Now, again, at the time, we didn't know that stocks had already topped. But this shows that the reason the tech bubble burst was because the Federal Reserve was actively lifting rates, creating an opportunity cost for capital that helped to drive money away from these exuberant valuations, these massive trends that had been building for years, and dot-coms with questionable revenue generation. And ultimately, it popped a massive bubble. And then once the sentiment bubble got going in the other direction, it becomes very difficult to stop. In the year 2001, notice the Fed goes in the exact opposite direction. 50 bip cut in January, another 50 later in January. One of those was an emergency cut, by the way. Another 50 in March, April, May, then 25 in June, 25 in August, then back to 50 for September, October, November, December. We saw Fed funds go all the way down to 1.75% from, after peaking at 6.5%. That was a massive series of rate cuts that we saw in 2001 as the Fed tried to stop the snowball from rolling downhill. But that's sentiment for you. It's the crowded theater smelling smoke analogy. That exit door is only so wide. If you start to smell smoke, are you really going to wait? Or are you going to run for the exits? Well, the point we're at right now, the Fed is in that cutting posture. There's not a reason for the Fed to be looking at hikes. And it looks as though Trump is going to get an amenable Fed share atop the bank as we go into 2026. That, I think, supports the melt-up thesis that we have in equities. 69.58, it's very nearby. That's my 2025 year-end target. I think that's still very attainable. 7K is where the plot thickens a bit. These major psychological levels can become a challenge, especially after a prolonged run where it could take a while before we finally leave it behind, to the point where, maybe buying the first breakout isn't the best way to go about it, but waiting for a check back with a test of support at that level, perhaps a bit more attractive. But I think there's probably a more attractive venue to be playing this theme of looking for weak monetary policy, massive fiscal expansion, by the way. If we look at the One Big Beautiful Bill, there's going to be no taxes on tips, no taxes on overtime, tax deduction for interest on cars. There's going to be a lot of stimulus that's going to be jammed into the system from every which way that I think all could contribute to a burst of economic activity that could play through in earnings and show through in stock prices. Happening alongside weak monetary policy. Well, the venue that I think is probably more attractive to play that is the long side of gold. Now, we're not hearing or haven't heard as much about gold over the past month and a half, given that we haven't taken out that high from October. But to my eyes, this is probably the cleaner market to be playing that trend until we get the Fed in a position where they ultimately have to hike rates because inflation is too high. Now, that may or may not happen next year, but if we get in that spot, that's where I think the trend in gold will finally start to pull back some. But for now, as we have the Fed in this uber dove mode, willing to cut rates, even with inflation well above target, I think the story really is told best from the way that gold operated in 2024. If we look at this on the daily chart, it took gold about 3.5 years to finally gain acceptance above the 2,000 psychological level. And it was in late 2023. This is when the Fed had started to highlight that they want to start cutting rates. Even though inflation was high, they started to say that they wanted to start cutting rates. And so we see gold finally pop above 2K around the December Fed rate meeting in 2023. And then it holds that 2K level of support in January. Now, this instance, there was 2 single days where gold closed below 2K last year, and it was around a CPI report. Tuesday, February 13th, there was a CPI report above expected, and there was very real question as to whether or not the Fed would be able to cut rates later in the year. A day later, Austin Goolsbee, Chicago Fed president, noted member of the Fed that's often watched on television. He can bring price swings in markets. He was one of the dissenters at yesterday's vote, by the way. But in a television interview, says, let's not get all flipped out about one inflation report. It wasn't one inflation report. The previous few were above expected, but that comment highlighted that the Fed would be willing to look past data that didn't suit their aim. And gold rallied above 2K a day later, and it never looked back. And it continued to rally and continued to rally. It finally took a bit of a break around the election last year, and for 2 months into the end of 2024, we saw this bull pennant formation build. Then as we came into 2025, we saw another breakout. That ran all the way until 3,500 traded. And then we had 4 months of digestion, and another bull pennant, another symmetrical triangle. That one ran all the way until Jackson Hole, right here. Friday, August 22nd, Jerome Powell finally opens the door to rate cut potential in 2025. Gold breaks out, goes parabolic, and just continues to run. Now, more recently, we had another build of a bull pennant formation that shows right here. Very cleanly. That one broke out around the news that Kevin Hassett was going to be named the next Fed chair. I.e., again, another very dovish push around the FOMC. That gave a strong rally, the pullback of which held a higher low, and we're back into another breakout mode. Into 2026, I think gold could very reasonably rally up to the 5K psychological level. That, again, is one of those massive prices that will often take time to leave behind. But there's nothing from gold's structure that indicates that this rally is done. And if I'm looking at the prospect of chasing stocks after a massive run when there's almost a commonly accepted bubble that's still building, I still like the long side of gold a bit more attractive than I like equities. But that said, I think we're still looking at the melt-up scenario in equities in 2026, at least until inflation surprises to the upside. If and when that happens, that could put the Fed in a checked position where they have to address rate policy. But until then, I think we're in a unique position to see a lot of forces pushing higher on equity prices. But that's what I'm looking at for 2026. That's what I'm looking at in gold. That's what I'm looking at in equities. As always, thank you very much for your time, and happy trading, ladies and gentlemen.